The idea of potentially banning Wall Street hedge funds from buying homes and forcing them to liquidate all their portfolios could have significant ramifications on the real estate market if such a measure were to be implemented. Significant decreases in home prices could occur in neighborhoods similar to those depicted. The logic behind this concern lies in the significant role these investors play in both reducing housing inventory and driving up prices. Before diving into the latest data, we kindly ask you to subscribe and leave a like under this video. Data from Redfin indicates a significant increase in investor activity during the pandemic, especially in cities like Las Vegas. In some cases, investors purchased over 30% of homes in Las Vegas and about 40% with specific zip codes. The proposed legislation known as the End Hedge Fund Control of American Homes Act mandates hedge funds to sell their real estate portfolios within a 10-year period. Failure to comply would result in a 50% tax on the portfolio's value. While the potential impact on home prices is a valid concern, it's important to note that institutional investors, including Wall Street entities, have already been reducing their presence in the housing market. For instance, investor purchases in Las Vegas have dropped by 65% since the peak of the pandemic, reaching the lowest levels in 5 or 6 years. The trend of selling among these investors may already be underway gradually across various markets. An example of this is seen in Henderson, Nevada, where American Homes for Rent, one of the largest homeowners in the U.S., sold a property purchased in 2012 for $530,000 and currently listed at $530,000. While there may be a gradual sell-off among investors, it's crucial to consider that the overall impact on the entire housing market may be limited. Investors, including hedge funds, own approximately 574,000 homes in the U.S., representing only 0.6% of the total housing inventory. While the proposed legislation aims to address the behavior of major Wall Street investors, it falls short in addressing a broader issue concerning investor demand in the housing market. With 27 million properties owned by investors in America, about 3% of which are hedge funds, considerations beyond targeting specific types of investors may be necessary. Instead, focusing on tax policies that encourage real estate ownership and affect both large and small investors alike could be more effective. The current tax policy allows real estate investors to write off a property's depreciation, resulting in potential annual tax savings. For instance, if a house is purchased for $200,000 and sold for $400,000, an investor could potentially incur losses of around $66,000 annually. This tax advantage incentivizes some wealthy and small-scale real estate investors to acquire properties and leave them vacant to benefit from tax deductions. Removing the depreciation advantage of owning real estate, particularly if it's viewed as an essential tax benefit, may encourage both large and small investors to sell their properties. This change could have a significant impact not only on markets where Wall Street investors concentrate their purchases, but also on various housing markets. Interestingly, even in the depicted neighborhood, there's evidence of a home purchase by a Wall Street investor, exemplified by Invitation Homes, the largest Wall Street homeowner in the U.S. with over 80,000 homes. A townhouse bought for $395,000 in April 2022 saw its value drop to $367,000. The investor's equity decreased by approximately $30,000 as a reflection of the loss. Digging deeper into the property's history, we see attempts initially to rent it out for $2,300, but the rent had to be reduced to below $1,700. This reflects a broader trend of declining rents in various neighborhoods in Las Vegas and leads to Wall Street investors lowering rental prices. The inevitability of this sale may stem from the challenges investors face in managing declining rents against rising mortgage rates. With a 30-year fixed mortgage rate equivalent to a 7% level and a 10-year treasury yield above 4%, these investors are navigating in an environment where government bonds yield similar annual cash flows to rental properties in Vegas. The increase in interest rates may signal the end of the hedge fund's home buying business model. However, it's important to remember that the potential impact of this law and the resulting sales may be limited to specific cities and neighborhoods. Cities heavily invested in by investors like Vegas, Phoenix, and Atlanta may experience more pronounced effects. For instance, during the last housing crisis, Atlanta witnessed significant investor activity. Some zip codes saw a 50% decline in home prices. Investors bought properties at lower prices and then contributed to the dynamics of local markets by renting them out. According to Redfin, at the peak of investor frenzy in 2021 and 2022, investors were purchasing around 35% of homes in the Atlanta metro area. This concentration was particularly pronounced at the southern end of the metro, where investors were buying up to 50% of homes in some low-income neighborhoods. A frequently overlooked aspect of investors buying homes is their tendency to target low-income neighborhoods. The logic behind this strategy is that home prices in these areas are often more affordable, potentially allowing investors to achieve higher returns. Unfortunately, this approach has led to undesirable outcomes, exacerbating housing affordability challenges in already struggling communities. Over the past decade, investors have focused on areas where residents already face challenges in affording rent and mortgage payments. By purchasing homes in these neighborhoods, investors not only drove up prices, but also created a situation where potential sales could have more pronounced effects. While the U.S. government aims to prevent a significant collapse in prices through legislation that gives investors a 10-year timeline to reduce their portfolios, some investors, especially those in affected neighborhoods, may attempt to sell their properties prematurely to avoid complying with the mandatory timeframe. The impact of this legislation extends beyond Atlanta, reaching cities like Jacksonville, where investors on the West Coast were buying up to 50% of all homes at the peak of the pandemic. This trend was particularly pronounced in low-income and high-poverty areas. However, the fate of this legislation remains uncertain. The bill, introduced to Congress by Democrats a few days ago, has not yet faced serious opposition. While some Republicans have expressed concerns about government intervention, the overall political landscape regarding the legislation remains unclear. The possibility of government intervention in the housing market to regulate who can buy homes has sparked debates about the potential consequences of such regulations. In this case, the proposed legislation targeting Wall Street hedge funds raises questions about the impact it could have on the real estate market. However, I must admit that this form of regulation seems to carry fewer potential adverse consequences compared to other regulatory measures. While some investors, especially Wall Street hedge funds, may explore creative ways to circumvent these regulations, the general sentiment is that many people wouldn't be disappointed to see these Wall Street assets exit the housing market. The potential ban on home buying activities could lead to attempts to circumvent the rules. But overall, the public seems to support this regulatory move. As the stock market reacts and potential consequences unfold, the uncertainty remains whether this bill will materialize into a significant regulatory change or remain more of a symbolic gesture by Congress. It will be interesting to see whether this bill gains traction and becomes a significant regulatory change or remains more of a symbolic gesture by Congress. Thank you for watching WealthStream 101. Don't forget to subscribe to the channel and leave us a like below this video.